Well, greetings and welcome to the Stifel webinar on what's going on in the Middle East. I'm Michael O'Keefe, Stifel's Chief Investment Officer. As is often the case, I'm very fortunate to be joined by a couple of colleagues here today. Our Chief Economist, Dr. Lindsay Piegza. Lindsay, welcome.
Thank you.
And then Brian Gardner, our Chief Washington Policy Strategist. So, Brian, thanks for joining as well.
Thanks, Michael. Good to be with you.
So, hey, we're here to unpack what is just a high volume of information with things going on in the Middle East. Just to kind of recap where we are. Obviously, over the weekend we had attacks by the U.S. and Israel on Iran with kind of an aggressive tilt, right? The elimination of Iranian leaders like the Ayatollah Khomeini and then very quickly, a very aggressive response from Iran, both back at those places, right, back to Israel, and I guess, think of it as some ships from the U.S., but where defense, mechanisms kicked in, but also a little bit more broadly in the region. And so ongoing exchange, building exchange. We want to kind of unpack sort of what's transpired, what it means. The first comment, of course, is the human cost, always a horrible thing. And we all, I think, start focusing on that, but then need to look beyond it to the global economy, markets, and what this means more broadly. I do think one anchor topic that we'll talk about throughout this is essentially the length of this. How long will this go? Will this be quick? Will it be kind of medium, or will it be extended? And the answer to that question will influence the ultimate impact, we think, on economic and market behavior. So, with that as a backdrop, let's start with how we got here. So, Brian, I want to start with you. And, I think the simple way to ask the question is it wasn't that long ago that the president and the activity was focused on negotiating peace. So, maybe you could tell us, in your view, and again, a quick-paced way, sort of how things unfolded, what transpired to get us where we are today.
Thanks, Michael. So before I get answer the question, I think you kind of set it up talking about markets and investments, and so we have to talk about this dispassionately. It may strike people as rooting for one side or another, or bringing certain bias into it, but we're actually taking bias out of it and trying to be as unemotional as possible, which is tough in these situations. That said, how did we get here? There were negotiations ongoing in Geneva between U.S. representatives and reps from the government of Iran. Uh, Press reports suggest that they were back and forth, that it looked like a deal. The president himself talked about this the other day, that they thought they had a deal, Iran backed away. They thought they had a second deal, Iran backed away. And I think it got to the final conclusion that Iran was never going to agree to any deal. Now, what that deal would have been, what America would have accepted, what deal was possible for both sides to accept is unclear. I think it's going to be years before we know the answer to that. But once it was clear that an agreement was of some sort was not possible, I think there was a determination to go, and the timing of that was dependent on intelligence that the U.S. and Israel were getting about the locations of key Iranian leaders, and that led us to an attack this weekend.
How much do you think the demonstrations on the ground in Iran had a role in this?
It's tough to say. I don't know that they were a proximate cause for the attacks. It's a good pretext for the attacks, and I do think you could feel pressure on the U.S. to do something building up as the protests gain momentum within Iran. The president himself leaned into that a little bit, but the administration is very quick to say this is not about regime change. That may be an Israeli objective, but the U.S. attacks are basically on military installations, and it looks like the U.S. Portion of the attacks is really aimed at degrading Iran's military capabilities beyond its borders. We had the attacks of June that was supposedly were taking out some nuclear sites in Iran. Questionable about how successful those were. The president today talked about the levels of uranium, the amounts of enriched uranium that the Iranians have. They also have other weapons, more conventional weapons that are able to reach outside their borders, and they've shown a willingness to use them. And so I think that all played into the decision to go in. But again, I think within the last 24 hours, I think the message from the administration has clarified that this is not about regime change.
Got it. That's actually very helpful. I want to turn to a near-term focus on the economy and markets. And I think first and foremost, when we've talked about this risk of Middle East war, it really is so much about oil, right? For supply and flow of oil. So Strait of Hormuz being closed, effectively closed at this point. Oil prices jumping a bit, stocks rolling over, not surprisingly. So, Lindsay, turning to you, let's talk about that from the perspective of near-term inflation and near-term economic risks.
Absolutely. Well, as a baseline, this is certainly less than the ideal time for a supply shock, with the international trade landscape already very stressed from the significant revisions that we've experienced international policy, including tariffs at the start of the year. Now, OPEC has responded with an announcement of a larger supply increase, but at least in the near term, as you asked, Michael, this isn't so much about supply as it is access to supply. You alluded to this. The Strait of Hormuz is unequivocally the single most important choke point in the global energy trade, and the consequences are already mounting. So, at the very least, this conflict is going to act as a meaningful boost to market uncertainty and likewise a sizable hit on confidence, as we would expect a material drag on global trade. Now, to quantify the effect, roughly every $10 price hike in oil translates into a loss of GDP, global GDP, by about 1 to 2 tenths of a percentage point.
Mm.
And of course, the pressure on global output intensifies the longer the conflict and the market disruption continues. So if we're looking out 2 to 6 weeks from now, then the disruption, the closure could lead to, well, a range of 2 to 8 tenths of a percentage point loss of global GDP, and so on, the longer the disruption continues. Now, when we talk about the disruption, I think it is important to mention that the impact will not be even globally. Staying near term, I do see the biggest impact will likely be in Europe. We were seeing some growth improvement overseas, but that is largely stalled with the imposition of tariffs. So now an energy price shock could have more significantly negative implications for growth and inflation abroad. Remember, Europe essentially imports all of its oil and certainly a significant share of its liquid natural gas. So a sizable supply shock could essentially replicate the recent crisis that we saw in 2021, 2022. Now, the one good piece of news is the timing. The crisis back then was coming right on at the start of winter. This is now as spring approaches, but inflation is already elevated across the developed world, so both here and abroad. So again, if we're talking about a 10% sustained increase in energy costs, this could amount to about 2 tenths of a percentage point increase in inflation here in the US, but up to 5 tenths in Europe, reducing GDP by roughly 1 tenth of a percentage point in the US, but perhaps double or triple that in Europe.
Hmm. So, Brian, turning to you a little bit, and I know you do a lot of work trying to translate sort of policy and events like this into market behavior. So, any initial comments on, and I would say globally, equity sectors and some considerations in that regard?
Sure. Let me just tick off a couple, Michael. Obviously, almost every sector is impacted, but some of the more notable ones that I've been looking at, defense, that's an obvious winner in the U.S. even before this weekend and the attacks, the president had been signaling large increases in the U.S. defense budget. It's questionable that he was going to get all that he wanted from Congress, but we were already set up for a fairly sizable increase above the level of inflation for defense spending. With the attacks ongoing, there are stockpiles that are going to have to be refurbished and replaced. And so I think defense has been responding to that. Energy has been off for the obvious reasons. And that's probably going to be a longer term, or at least midterm, middle length term question about how quickly that move in energy stocks changes. Banks have been reacting to changes in the yield curve. And I'll just point out that the property and casualty sector, probably more international than in the U.S., but maritime risk, wartime risk policies have been actually helpful to that sector. I think you've seen some of the stocks in that sector rising on the prospect of premiums firming. The president came out just before we started the webinar with a promise to provide guarantees, risk guarantees. This is to help the flow of oil through the straits, because ships won't go with the prospect of war in the area. They cannot get the insurance they need. At the same time, the other side of that is, okay, now they're going to have risk guarantees from the federal government, but there are production issues as well, and that kind of goes into the energy question. As some of the production sites in the Middle East have been hit, and no matter how much guarantee you give to shipping, if you can't produce, there's really nothing to ship, or less to ship. So these are some of the sectors that we've been looking at.
Yeah, and maybe just to sort of round it out in terms of market behavior, it's been interesting in that obviously we talked about oil. Gold was up, but then a little bit volatile. Interesting, dollar strengthened a little bit. I thought it was very interesting that we saw non-U.S. markets trade off hard on Monday, and U.S. markets stayed pretty steady. And then, as we've moved along, we saw some weakness that then has recovered some today. So it's almost like, and maybe Lindsay, it relates to your comments about impact, the impact being more dramatic outside of our borders. And to be honest with you, I think we've all watched the vol. We'll get into this a little later, but the volatility and repositioning the markets as it relates to other forces, artificial intelligence being one. So it's been an interesting time. As it relates to the short term, that idea of supply, that choke point, Strait of Hormuz, is something that we'll keep a close eye on. A second, I think, and again, I'm not an expert at this, and Brian, maybe you have a comment. Sort of like the military inventory. How many rockets does everybody have to keep going here? And from both directions, basically. And it seems to me, watching for how the patterns shift in terms of the way this conflict moves along, if it continues, I think will be super interesting. But anyway, Brian, to you, maybe on that topic, but then as well, I want to hear from you on the potential for broadening. So on one hand, we've seen Iran attack other countries, essentially bases in other countries, at least in the Middle East. But then there's the question of China, Russia, and does China somehow feel more emboldened to act on their own in other areas, Taiwan being a good example? What are your thoughts?
There's a lot there, Michael. So let's try to unpack it. So let's start at the beginning. War is unpredictable, right? Wars are easy to start, they are hard to finish, and they're unpredictable in the direction that they take. Specifically to Iran and the situation in the Middle East, you alluded to it, stockpiles. We don't know how large the Iranian stockpile of more conventional weapons is. In addition, we don't totally know the domestic situation in Iran. You have two parts of the Iranian military, the traditional army and the Iranian Revolutionary Guard. The Guard is more inward-looking, it is more fanatical, it is more supportive of the regime, where the outward-looking army is more for border security and outward defense, but it's not as ideologically fanatical as the Revolutionary Guard. To the extent that the traditional army takes a different position from the Revolutionary Guard, you could get regime change from that, right? And the influence on who leads Iran. We don't even know who is running Iran as we hold our conversation today. So we don't know who's going to be the ruler of Iran next week or the week after. And there are internal conflicts and forces that are going to be at work there. So that's going to have a lot to do with how long this conflict goes on. Externally, I think the ramifications are significant. What we've seen over the last couple of months, going back to the June attacks on the Iranian nuclear facilities, to the U.S. attack and the removal of the head of Venezuela, Mr. Maduro, and what we're seeing now is that Russia and China are not in a position or are unwilling to engage directly militarily. That does not mean that they are not responding in other ways. Cyber attack, probably ongoing as we speak. But it does call into question how willing China is to engage beyond its borders. Taiwan is a separate issue. This has implications, I think, as well for currencies. I mean, people have been talking for a very long time about an alternative to the US dollar, some kind of BRIC security. Well, if China is not willing to use its military might abroad, and Russia seems to have been significantly degraded in Ukraine and was unwilling to help the Syrian government when the Assad regime was in its last throes, and now is not intervening as far as we can see in Iran, that calls into question how powerful they are going to be and how influential they're going to be in creating this alternate to the dollar. So I think there's a lot going on and this is going to have ramifications for years ahead of however long the current conflict lasts.
Yeah, yeah. Well, let's come to that. You know, it's always, I think, incumbent on us to take a look at this and this kind of event and say, well, what horizon are we looking at? What are the paths to ultimately resolution to peace in whatever form it takes? So, Brian, to keep you on the spot a little bit, what's your view on that? Like, what do you think? What's your view on how long you think this will last, and what might be that path to getting past it?
I'm really reluctant to getting into predicting how long it's going to be, Michael, because we just don't know. I mean, you have to have an informed opinion, and unfortunately, information is not readily available. Again, what's the internal situation in Iran? Uh, the population is clearly in the mood for regime change. I would say about 80% of the Iranian population supports a change in regime. That means that there's still 20% that supports the regime, and they have weapons.
Hmm.
And so how this plays out internally in Iran is going to have a large impact. And it's hard to have an insight into Iran. It's a closed society, not getting any information out. So we don't know. And like I alluded to earlier, I don't know what their conventional stockpiles are. They're clearly willing to use them, but they cannot resupply them.
Right.
The resupply chain for them is closed. And so they're not getting anything that Russia could give them has to be used elsewhere, being Ukraine. And so Russia is not a viable alternative. China has shown itself to be unwilling to engage in this at this point for various reasons. And so, it's probably not going to be resupplying Iran. Iran's kind of on its own. So that would lead you to think that it may be kind of a shorter term engagement. But again, there's always a risk that this goes on further. We don't know.
Yeah, yeah, yeah. No, that makes sense. So, Lindsay, coming back to you, and you made a few comments about the economy and inflation. Before this all started, you had sort of shared a lot of good work, and sort of underlying there was I would describe it as an optimistic view of 2026 for U.S. GDP. So maybe you could comment on that. as well as your views, extending your views on inflation, but then the impact of this, especially in again, you quantified it some, but if it goes on a bit, how that might impact your view for the year specifically.
Absolutely. Well, volatility aside, as a baseline, as you mentioned, we do expect the underlying themes of a solid consumer base, positive investment flows, significant gains in productivity, largely attributed to the expansion of technology, to lead to a relatively solid growth profile for this year in the range of 2.5% to 3%. Now, on the inflation front, broadly speaking, for the U.S., trade exposure to the Strait of Hormuz is limited, but higher global oil prices will work to fuel already elevated costs in the U.S. Now, I don't want to throw complete cold water on what we've seen. We've seen tremendous progress in terms of taming inflation from those earlier peak levels. But prices are still rising in the US, and inflation remains well above the Fed's 2% target. So even before the recent events that we're discussing on today's call, inflation was poised to remain elevated in a range nearer 3% for the year. But at this point, after years of price hikes in the aftermath of the pandemic, and remember, we're talking double-digit increases across nearly every category of expenditure, from apparel to transportation to groceries. U.S. consumers are already stretched thin and are incredibly price sensitive, particularly to gas prices. So keep in mind that when we talk about the American consumer, the fastest way to derail the American consumer is with sustained heightened energy prices. In fact, it's broadly estimated that a $1 hike at the pump can be associated with a loss of over 1 billion in expenditures elsewhere, potentially translating then into a loss of up to several tenths of a percentage point in growth annually. So at the same time, we talk about the potential duration of this conflict. If the conflict drags on and begins to weigh on investment, consumption, confidence, the very factors that I mentioned as supports to our baseline forecast, well, then growth could dampen as well. Although I would point out that as a net oil producer, higher energy prices will benefit at least some sectors of the economy, including domestic producers.
Understood. Brian, back to you for a quick second. And it's sort of a broad question. Your view on putting, we obviously have the transport of oil in focus, but there's shipping more broadly and what I would call as a result supply chain implications. Any initial views on how this uncertainty might play out with that?
Um, yeah, I mean, it's tough to say from Washington, Michael. To be honest with you, it is another risk that Lindsay's kind of alluded to on the energy side, but you know, I think this goes in. This is a longer term issue on supply chain risk, connected to the tariffs, connected to the ongoing trade debate that's going to pick up steam over the summer with Mexico and Canada. A lot of the focus of the review of the USMCA, the U.S. Mexico Canada trade agreement, that's a lot of that's going to be focused on country of origin rules. So I think companies have to remain flexible because the rules of the game are changing in terms of supply chain management, and I don't think there's an end game in sight yet.
Yeah, and I mean, I would say just broadly, there was already such a movement towards on or near shoring
Correct.
that it's sort of less shipping,
But
marginally at least.
right, but it's complicated because part of the nearshoring effort has led to an increase, an economic boom for Mexico. But part of that is China coming in and using Mexico as a backdoor for some products, and that's going to be at the heart of the review of USMCA.
Interesting. Well, just to comment on the markets just a little bit more. I mentioned earlier, and Lindsay, you alluded to this technology innovation, artificial intelligence. We've seen a real broadening returns this year so far. and sort of shifts in leadership. Meg 7 down a little bit. This obviously, these events have increased uncertainty, they've increased volatility. But one thing that everybody pulls off the shelf when this happens, there have been studies done on past geopolitical events, right? Asking the question, well, what happens after the first 3 months, 6 months, in a year? And let me just give you the numbers. On average, going back quite a long time, geopolitical events, the equity market on average is up, and it's the median of all that, over 4% after 3 months, over 5% after 6 months, and over 10% after a year. So there's usually this big shock, things move down, events sort of people figure out what's happening, get used to it, maybe confidence comes back a little bit, Lizzie, to your point, and then markets recover. So for those that feel nervous, that they feel they want to pull out of the market, it's that classic, remain invested as a long-term investor. Now we've got about 5 minutes left. I want to turn to what we like to call among our group here a lightning round. So quick pulse checks on somewhat related and somewhat other topics. So I mentioned, this idea of market dynamics and artificial intelligence on one hand, creating a lot of optimism, but we also see industries trading down if new products and new services might put some of what they do at risk. So that's been in play for sure. Another factor that's been in the news quite a lot is employment, the effect of artificial intelligence on employment. There was sort of a thought piece done by a group called Citrini that sort of talked about massive unemployment, and then a response from another company, Citadel, on that. So Lindsay, I'll turn to you for just your brief assessment of that.
Well, technology has been a consistent and significant contributor to productivity, and really for businesses has acted as a cost savings lifeline, offering a lower cost labor alternative. But when we're talking about AI, supposedly or potentially expected to replace over 9 million jobs globally this year alone, and potentially automate north of 80% of tasks currently performed by humans, by you and I, by the year 2050, we can't underappreciate the displacement factor that this will have on current and future labor market participants. And remember, we have nothing to compare this to, no historical precedent. Now, we've had other technological revolutions, of course, technology-driven cycles, but typically, this has been a labor augmenting cycle, not a labor replacing cycle, meaning that these jobs are replaced, as we see going from the typewriter to the computer or automating toll booths. And these individuals are taken out of the labor force, retrained, and then they re-enter the labor force in an entirely different capacity. But this time around, AI is a different animal altogether, potentially permanently displacing or replacing the human component from the equation altogether. So the question is really what happens to the economy if 20, 30, 60% of the labor force is permanently displaced? One could argue at the very least, we're going to see a growing divide between those able to work with AI and those displaced by AI, but maybe more of a dire prediction, as we're seeing in some of this literature, an increased burden on an ever shrinking portion of the population that's still participating in the labor force, and then eventually tipping the Laffer curve and removing an incentive for anyone to participate. So there's a lot of question marks right now around AI, and it seems to be moving at an exponential pace where the literature and the analysis and the legislation and control of AI is slow to keep up with the growth.
Yeah, a lot to unpack. We'll probably do a separate session on that altogether. When I thought about framing up today's discussion, I thought I'm going to have the two of you together. I wanted to ask you quickly about the nominee for Fed chair, Kevin Warsh, both likelihood of confirmation and any policy shifts that you might anticipate. So maybe Lindsay, starting with you.
Well, Warsh spent many years at the Fed, and if you remember, he's championed as the primary liaison between Washington and Wall Street during the financial crisis, which is to say that he's well known to the markets. That being said, he was a well-known hawk back then and has since shifted his position on policy to align with the president's call for lower rates. Now, assuming he does come into a leadership position, given the still solid nature in labor market conditions and still elevated inflation, a Warsh Fed was already going to face sizable challenges to any further reduction in policy. But now you layer on a global energy price shock, potentially re-accelerating inflation, and this is going to make it even more difficult to justify any additional accommodation. And this is a theme that's going to occur not just at home, but globally. We see the odds for an ECB rate hike, for example, have climbed noticeably in the last few days. Australia has now called for every meeting to be live to potentially raise rates. And as we saw in the January FOMC meeting minutes here at home, several Fed officials were already willing to consider a rate hike scenario given the persistently elevated nature of inflation. So now the war with Iran could result in a global central bank tightening cycle much sooner than expected. Again, if prices are sustained and conflict is drawn out for a
Right.
long
It goes
time.
against the let's cut rates now goal here.
It certainly
Now,
does.
yeah, Brian, to you, what about not what about his confirmation? What do you think?
I think I think the confirmation is on track. I haven't heard anything over the last couple of days that suggests that that's in doubt. The timing may be questionable at this point. I think the administration wants to have him in place for when the Powell term is over in May. But the administration still has not formally submitted his paperwork to the United
Hmm.
States Senate. And so there is a confirmation process. We knew going into before this weekend that it was going to be slow because of the DOJ's investigation into Jay Powell and allegations or the potential that he may have lied to Congress in some testimony last year. Republican senators who have significant leverage on the process have pushed back on that. They want the DOJ investigation kind of disposed of before they vote on this. So you always had that, which threatened to drag out the confirmation process. The administration's attention has clearly been diverted, including the Secretary of the Treasury, right? Treasury has a role in international finance and the economy, and between the tariff decision of a couple of weeks ago and now Iran, Secretary Bessent is involved in that. And so getting the ducks in order to get the nomination formally submitted to the Senate and get it through the Senate Banking Committee and through the Senate floor, it's not impossible to have him in place for May, but the chances have gone up that this may take a little longer.
Yeah, yeah. Makes sense. I had a few other questions. We're kind of out of time. Let me wrap it up by describing first what, I think collectively we're going to be keeping an eye on. Obviously, the energy markets generally, logistics around oil flow, logistics around shipping, supply chain, as we talked about. Um, really any signs that there's a sense of things coming towards a close, like in terms of especially how long Iran, if you will, lasts with their effort. I'd also say related to that policy narrative, like what are we hearing from leaders as it relates to what's been accomplished and what they see going forward, because we're all dealing with so much uncertainty. And that leads to sort of the high level observations about investing. This is probably one of those times that really highlights the benefit of diversification. We've been talking about that for a while. This idea of artificial intelligence and impact of artificial intelligence on markets and sectors and industries is really leading to a bit of a market rotation, as I mentioned before, and really essentially we're in an environment where the winners are going to win bigger and the losers are going to lose bigger, right? So that again argues for diversification. And then, this kind of environment, I might have mentioned at the beginning, I should have mentioned, we do this work we call our geopolitical risk dashboard, monitoring a lot of different possible risks. And Middle East war is on that, right? So this is something that seems to be playing out. But just think of it as in the work that we do collectively, the three of us and others at the firm, we are mindful of risk. It's not to be reactionary. You'll never see us, running for the hills, if you will. But it's really about trying to understand the signpost, trying to understand what's around the next corner, and then as we sort of guide clients in their investments, being mindful of that, so that diversified strategy ends up playing out well for them in whatever environment we see. So with that, I want to start by thanking Lindsay and Brian, each of you, for joining today. It's very much appreciated that you took the time to be with us.
Thank you, Michael.
Thank you.
Yeah, and to the viewers, thanks for joining. You can always reach out to your financial advisor at Stifel in terms of wanting to get to us. We're all pretty available, and if you have questions that you want to follow up on, go through them, and we'll look forward to seeing you the next time. Thanks so much.